Hi folks, and welcome back to Meaningful Money. Okay, I'm still here in my field just above Merry Maidens where it was very windy, so I've just moved around the corner to a sheltered spot. Meaningful Money is once again brought to you with the help of my good friends at 7 Investment Management, so thank you again to them for their support. We're going to move on to the second of our success factors now. Now, these are factors which will either help or hinder us in our financial planning by impacting the returns we get on our investments, right? So last time we talked about time. It was time last time, but this time we're talking about cost, okay? Now, you'll remember last time we talked about compounding, where you can harness the power of compound interest, adding interest onto interest onto interest, so that over time your returns on your money kind of snowball. They get bigger with every year, right? Well, with costs, it works exactly the same way, but in reverse. So, the costs you incur on your investment are a drag on performance, and particularly the longer you invest for, the bigger the drag of those costs. The bigger the impact they have on your returns. So I'm going to illustrate that, okay? And I'm going to have either side of me 2 investments. One over here is a clean investment, one with no charges at all, no initial charge and no ongoing management charges. It's fictional, as you can probably imagine. Over here on my left is going to be an investment with a 5% initial charge and a 1.5% annual management charge, right? So let's see how they get on. Each one of these investments is £10,000 to start with, and it grows at 5% a year, right? So here we go. At the end of year 1, this clean investment over here, the £10,000 has grown to £10,500. Simple 5% growth, right? Over here though, we've had our 5% initial charge taken off to start with, so we're already 500 quid down. But it's grown a little bit by the 5%, but it's had the annual charges taken off. So it's actually only grown by 3.5% in that first year. So over here now we've got £9,832.50. So we're already, we're in debit over here, in credit over here quite comfortably. Already 700 quid difference between these two investments. But it's the first year, and that's where all the initial charges are taken out on this one. So let's see how we get on going forward. Well, at the end of year 2, over here we've got £11,025. Over here we've grown to £10,760 and 64p. Okay, so it's growing still, but quite a difference between these two after only 2 years. Well, let's fast forward a bit to year 10. Well, our clean investment over here is worth £16,288 and 95p, whereas over here we're only worth £13,400 and 69p. So the difference of those costs over 10 years is, well, what's that? A little under £3,000. Now that's a lot of money on a £10,000 investment. That's a 30% difference based on the initial investment. So you can see, hopefully, how costs and charges is a huge drag on performance, okay? So you need to know what the costs are when you're investing. This is the second thing, okay? Firstly, we've got to keep costs down, and secondly, we've got to know what those costs are so that we can keep them down. Now, in a bank account, there are no sort of explicit costs. You just get given your interest rate and that's it. But if you're investing in real assets, shares or funds or bonds or whatever, there's always costs involved, and you must know what they are, and they must be kept to a minimum. You will hear 3-letter acronyms like AMCs, annual management charges or annual management costs. You will also hear something called the TER, the total expense ratio, and that's the one you need to look for really. AMCs are the sort of headline rates, the annual management charge, but there are other costs which are buried a little bit inside something called the TER. And even within TERs, some other costs like stamp duty on share trades and stuff within the funds, they're still hidden. So you need to know what your costs are and keep them to a minimum. Now, I'm not against paying money to invest if you're getting value, and that's the big if really. So I have clients pay me every year to help them look after their money, but they tell me that they get good value for that, so they're prepared to pay it. I'm happy to believe them, of course. So know what your costs are and get value for them, but keep those costs down. Thirdly, there's another kind of cost which we haven't even touched on yet, and that is tax. This is just a charge by another name, okay? So you need to reduce the tax in your portfolio, in your investments, as best you can. So use your ISA allowance, okay? Use pension contributions, because those are all very tax efficient ways of investing. If you've got a lot of money, think about enterprise investment schemes or venture capital trusts. These are all ways of reducing the tax payable on your portfolio, and should be taken advantage of, because tax is also a drain on your performance, okay? So remember, costs are compounding, but in reverse, okay? They are a compounded drag on your performance of your portfolio. So you must know what they are, know the difference between AMCs and TERs, particularly on funds, OICs and unit trusts and things like that, and keep them right down. Make sure you're getting value for whatever charges you are paying. And also keep your tax payable down, okay? Within reason. There are all sorts of esoteric schemes which can, or which claim at least, to be able to remove you from paying tax altogether. As I've said before, I have a bit of a moral issue with that. I've sort of come up against clients who say they don't want to pay any tax at all. I don't take them on as clients, because I figure if you're driving on the roads and using hospitals and things, you should be paying some tax to pay to pay for those things. But where there are allowances, use them, okay? So that's cost, the second of our success factors, okay? So next time, we're going to talk about risk. So from the field here up above Merry Maidens, thank you very much for watching, and I will see you next time.